I want to hone in on a very fascinating story early in the flows this year, and that is the ETFMG Alternative Harvest ETF, which is a pot ETF. It tracks pot stocks mostly in Canada, and boy, has it become a sensation. Now, before you look at this chart, you see all the flows kicking in here. It really got to be a pot ETF after a name change and a strategy change. It was a Latin America real estate ETF. Basically, nobody cared about it. And then it switched to pot stocks, and boom, it took off. It's got $345 million in only 10 days on the market. So it's on pace to hit $1 billion in just under 2 months. That would make it the second fastest growing ETF of all time, to put that in perspective. Now, why are people jumping into the pot ETF? You have to look at the performance. It's up 25% this year. That makes it the second best performing ETF. That definitely draws in a certain crowd, but I don't think that explains all of the flows. I think you go and you look at Canada for an explanation onto why there's so many flows into this beyond performance chasers, and it's just because people like this story. They read about it. They want to be in this story early. The Canada ETF is up to $660 million. And look, when the Canada ETF came out, the price went down, but the assets stayed. That's rare. Normally, you see people bail. They hung in there, and that shows you a sticky assets in Scarlet. With this kind of sticky assets and that kind of performance, this ETF is off to a big start, punching way above its weight.
Yeah, and investors' patience certainly have paid off as well. Let's bring in Matt Hogan, CEO of Inside ETFs. He is based in San Francisco, but visiting us in New York today. Matt runs the world's largest ETF conference, which takes place later this month, and has been named one of the 25 most influential people in the ETF industry by ETF Database. Matt, it's easy to write off POT and MJX as gimmicky ETFs, but their asset growth, as Eric was just showing us, shows real potential staying power. So how rare is this, and what kind of copycat issuances do you foresee?
Well, we've actually seen a number of thematic and niche ETFs gather real big assets out of the gate. You had the Robo ETF, went quickly to $1 billion. You had the Bots ETF, go quickly to $1 billion. I would put MJX in that category. It's a hot theme in the market. People see the performance. They know that cannabis could be a massive industry, and they flood in. I don't know if that's a good idea. I think the sound and the fury overweighs the value of it from an investment perspective, but we've seen niche ETFs grow substantially.
Now, there's been some talk about this ETF did the name change, and there's been hesitancy from custodians to actually custody pot stocks in this theme. Do you see any possibility of some kind of a sudden closure in this one down the road?
It's definitely a risk. So there are two big uncompensated risks if you invest in a fund like this. One is the risk of Jeff Sessions clamping down on the industry writ large, and the other is this custodial risk, right? It did shift from one ETF focus to another. People had tried to launch pot ETFs before. They couldn't get custodians to hold the stocks because it could be a threat to their banking licenses. There is a risk it shuts down. Investors should know if it does shut down, you don't lose your money. It sells the stocks, you get paid out in cash. But it is a taxable event that you can't control. It is a risk worth thinking about.
Now, let's talk about the Inside ETF Conference, because that takes place in 2 weeks. And 3 years ago, you made some bold predictions in your presentation. You said ETFs would top mutual fund assets within a decade, and that ETF assets would approach $16 trillion by 2024.
Yep.
Is that still your call?
Absolutely. We're on pace or more. Look at last year. We had $477 billion in net inflows, assets up almost $1 trillion. I think that's going to accelerate from here. We've seen fixed income assets come online. I think we're going to be at that or ahead.
And you could see that acceleration will really pick up. How much cheaper do you think ETFs have to get to drive that last leg of growth?
Well, ETFs are already extraordinarily cheap. You can buy the U.S. asset for 0.03%. I think we're going to see continued fee compression, particularly in smart beta. You've seen fee compression in commodities. I think we'll see it even in niche ETFs. Everything is going to price 25 basis points or lower. That's the way the industry's headed.
With that chart, those are assets, right? But this year, active mutual fund assets actually grew more than ETF assets because the market was so good to them, right? 10 trillion base, you grow by 1.5 trillion. Is that projection going to take a bear market? Active managers seem to be slightly rooting for one that you can see, oh, this is our value, wait till the market goes down. Do you think a bear market's good or bad for ETFs?
Yeah, bear markets always are good for ETFs. So there's this myth out there that money will flood back into the active space in a bear market. That wasn't true in 2008. It wasn't true after the 2000 bubble. In each case, ETFs had an increase in inflows. So that's a story active managers like to tell each other, but I don't think it's true. Will people adjust their holdings? Absolutely, but you'll see flows accelerate if there's a down market and really accelerate if there's a panic.
Okay, do you need star power to get to $16 trillion in ETF assets? Because music producer Quincy Jones will be at your conference. His appearance is tied to a new ETF that invests in companies streaming music and entertainment. Do you think celebrity endorsement is what's needed to draw attention to some of the more quirky, niche ETFs that would otherwise maybe get lost in the crowd and eventually liquidate?
For sure. Here's what I think about the Quincy Jones ETF. It's actually not competing with the ETF industry. That ETF's competing with fintech apps like Stash and other ways that millennials are putting money into the market. So the idea behind celebrity-driven ETFs is not for a 60-year-old working for an advisor. It's for a 25-year-old looking for their first place to invest. And they love streaming music, and Spotify's going public, and what could be better than QJ? So I think it's an interesting ETF. I do think we'll see more, but it's not focused at the core of the ETF market today. It's focused at the millennial generation.
Now, you and Dave Nadig always give this fantastic presentation every year at this conference. I've been like 5-6 years. What topic are you going to hone in on this year? What are you going to talk to us about? Give us a preview.
Well, a couple things. We'll obviously talk about the growth that was so massive you can't ignore it. But we want to focus on is people should be looking how to protect their downside in today's market. We're going to be talking about ways to take money off of the table. I changed my own portfolio allocation for the first time since 2006. Now, I didn't make a massive change, but I think if you're in a market where utilities are trading at a PE of 30, everything's run up, it feels a little bit rich. How do advisors reposition their portfolio using ETFs, options, or other strategies to take some risk off the table? We're going to talk about that a lot.